How do you get optimal capital for your business? Look, it's not enough for you just to be able to get credit cards and credit lines and loans. You have to be able to get the most money at the best terms. And 99% of entrepreneurs I talk to are not doing this. Even when they're able to get funding, they're only getting a fraction of the funding they should get, and they're paying way higher interest rates and way higher payments than they should be. So in this training, I'm going to map out the 3 things you need to do to get the most money at the best terms, i.e. what I call optimal capital for your business. So you get more approvals, higher approval amounts, lower interest rates, and lower payments so you can get a lot more money and keep your payments as low as you possibly can. We got a lot to cover in this training to decode these 3 steps, so let's dive in. So let's talk about optimal capital. Look, I talk to a lot of business owners that get money, but the problem is that they're getting way lower approvals than they should get, or even worse, they're paying higher interest rates than they should, and that makes their payments way higher than they should be. Let me give you an example from my own personal life. So the very first loan I ever got for my business was $75,000. Now keep track of this math, and my payment was over $9,000 a month. It was called revenue lending. I had a relationship with the lender. I even got a great rate, and because my term was so short, I still paid $9,000 for a $75K loan. Now, my second loan I got was for $325,000, and my payment was only $4,600 a month. What? I got $250,000 more in funding and cut my payment in half. How the heck did I do that? That is what optimal capital is. Optimal capital will get you longer terms, lower interest rate, higher approval amounts so you can get more money and keep your payments way smaller. But how do you do this? Well, there's 3 things you need to do. There's 3 things that I did to go from that $75,000 loan at $9K a month to $325,000 loan for only $4,600 a month. Here's the 3 things you need to do. The first is you got to set up your business where it's fundable, where it's credible to a lender. It's the number one thing they look at. It's the number one reason that loans and credit applications get denied. It's the number one reason that you won't get the amount of money that you actually want to get. And this is all called fundability. It's broken down to about 120 points that lenders look at, known as fundability. Now here at Credit Suite, we get you access to a fundability score so you can actually see how fundable your business is. So get in touch with us if you'd like to see how fundable your business is. We even assess your fundability now and give you tips and tactics on what to fix. So here's what you need to know. Your reputation matters. You need to have your entity set up correctly. You need to have a business address and a business phone number and a professional website and a business email address, a business license, a business bank account. Your business needs to prove that it is its own entity separate from you. It becomes very important. And then you need to dive into everything that makes that entity creditable, right? Your information on your application should match your Secretary of State everywhere that they see it online. Every aspect of your business should be reflected that you are a credible business, that you are somebody that they should want to lend to. If you just do this one thing correctly, you stop chasing lenders, lenders start chasing you. What I mean by that is you start getting automated approvals. There's not even manual underwriting. You start getting pre-screened offers. Lenders start going to you and soliciting you to do business with them because you meet their criteria. It all comes down to fundability, and fundability is the key to stopping denials and getting more approvals. Now that brings me to step 2 of this plan, and that's building business credit. Business credit controls 2 things: how much you're going to get and the rates and terms you're going to pay. Look, the business credit reporting agencies say on their business credit reports how much recommended credit you should have. They're literally telling lenders, they're telling credit issuers how much money those lenders and credit issuers should give you. Now, the more accounts you put on your business credit reports, the more you pay those accounts as agreed, the higher your recommended credit will be. Look, I look and show credit reports publicly that have $720,000 or more in recommended credit. And I show credit reports with $1,000 in recommended credit. I know we would both rather be recommended for $720K than $1K, right? But it comes down to one point. The credit reports that show $750,000 in recommended credit have 15 accounts or more on them. The ones that have $1,000 in recommended credit usually have 0 or maybe 1. So the more accounts you add to your business credit reports and the better you pay those accounts, the more likely you are to get higher approval amounts and better terms. So breaks down twofold. First of all, the more accounts you're adding to your business credit report, that usually increases your recommended credit. So continue to build business credit, and the more accounts you add to your business credit reports, the higher the recommended credit, and typically the higher your credit card limits, your credit line limits, even your loan amounts will be. The second part, your credit score matters. Business credit reporting agencies issue credit scores to assess your risk. The lower the risk, the lower your rate, right? The higher your risk, the higher the interest you're going to pay. That's how lenders and credit issuers look at it. So oftentimes, lenders and credit issuers are determining the interest rate that you're going to pay based on your actual credit scores. So the more credit you have on your credit reports and the more and better you pay that on time or early, the better your credit scores and the better your interest rates will be. This also ties into how long of an amount they give you to pay them back. So that means just by getting accounts out of your business credit reports and paying those on time or early, this will increase your recommended credit, getting you higher approval amounts. By paying on time, you'll get a longer term and you'll also be able to get lower interest, which helps you borrow even more money. And that's why step 2 of this process is so important. And that brings me to step 3. Step 3 is you have to know what your strengths are. Lenders categorize these strengths 3 ways: cash flow, credit, collateral. You need to have strengths in all those areas or one of those areas to get money. And when you know where your strength is, that's the kind of money you want to go get. Let me give you an example. If I have good revenue, I manage my bank account responsibly, my revenue is increasing month after month, I have a balance in my bank account, then I can go for a financing like revenue lending that just looks at that asset as my strength. They're just looking at the fact that my revenue is consistent, and based on that one thing, they're going to give me financing. Now, if I have good personal credit, then I might go get a program called Credit Line Hybrid, where I can get a $150,000 credit line with 0% interest rates for like 18 months. I mean, the lowest you're going to get is 0%, and I can get these credit lines just because I have good personal credit. Or maybe I don't have good personal credit. Maybe I don't have revenue, but I have like an asset: stocks, bonds, 401ks, IRAs, inventory, equipment, vehicle, real estate. Well, then I can go with asset-based lending using that asset as collateral. And even with bad credit, even with no revenue, I'm still able to get interest rates lower than 2% because I have some kind of collateral I'm pledging to the lender. What is your strength? Is it cash flow? Is it credit? Is it collateral? If it's none of those, you really want to start building business credit and use business credit to fund your business. Look, business credit can pay for almost everything you need to get in your business. But if you have cash flow, credit, or collateral, you want to look at one of those types of funding programs. That's going to get you the best terms because they're looking at the strength that you have. The worst thing you want to do is go to a lender that's looking at revenue when you don't have any and you have good credit. And they're going to turn you down or give you really bad terms because you don't have mainly what they're looking for. And that's why step 3 is so important. Knowing these 3 C's, knowing what lenders look for, finding a loan program that focuses on your strengths and ignores your weaknesses is the final piece of the puzzle to getting the most money at the best terms. Oh, and by the way, if you have all 3, cash flow, credit, collateral, that's when you get SBA loans. That's when you get the longest term, the lowest interest rate, the lowest payment loans out there because SBA is giving you 15, 20, 30-year terms. You see, that's why my payments were so high on $75,000. My loan term was like 2 years. But when I borrowed $325,000, my loan term jumped to like 15 years. And that extra time to pay it back is what helped me get so much more money and keep my payments low. So those are the 3 steps to get optimal capital for your business. Make sure that you improve your fundability. Make sure you're building your business credit. Make sure you understand the 3 C's and are applying for the right kind of financing that focuses on your strength. If you do that, that's going to get you optimal capital, the most money at the best terms for your business. By the way, at Credit Suite, this is what we do. We help you improve your fundability, build your business credit, and get financing. So if we can help you along the way, let us know. And if you got value from this training, like and subscribe, and keep our eye out for our next training that talks about more cool ways to get the money you need to start and grow your business.